Are you interested in learning more about the book value through both visual and explanatory examples? Well then, you're at the right place. Today I'll be going through the book value in 4 simple steps. I'll start off by going through the definition of the book value, then I'll walk you through its calculation, then we'll go through a real-world example of how to calculate the book value, and lastly we'll consider some of the limitations the book value also has. And just so you know, I am not a financial advisor, so take what I say with a grain of salt. You're in charge of your investing decisions, and I am not liable for any gains or losses based on your decisions. So welcome to Investinality, your go-to resource to weather all market conditions. Thanks for joining me. Now, let's begin. Let's take the first step, which is the definition of the book value. So book value is equivalent to book value per share. It is the amount shareholders receive if all assets are liquidated and liabilities are paid off. Now that we know this, let's walk through the calculation of the book value. So the book value, also known as BVPS because it's book value per share, is equivalent to the book value divided by the number of shares outstanding. And the book value can also be known as stockholders' equity, or more in general, the company's total assets minus its liabilities. In order to calculate it, we need 3 different values. We need the assets, which are how much the money makes. We also need the liabilities, which is how much the company owes. And we need the number of shares outstanding. Let's walk through an example of how you can apply this to an actual company. So the company I've chosen is Microsoft. Now I've chosen this just because it's a well-known company. Again, this is not a recommendation to buy, sell, or hold Microsoft. It's just an example of how to use Microsoft's balance sheet to calculate the book value per share. Great, now let's begin. Hey there, now I'll be walking you through how to calculate a company's book value based on its earnings. So the example I'm going to use is Microsoft. The way to search for this would be searching Microsoft Investor Relations, and this should take you to Microsoft's page where you can research on its earnings. So here's the Microsoft Investor Relations page. Once that loads, we can see that Microsoft FY24 Q3 earnings are here, which is Microsoft fiscal year 24 third quarter earnings. Let's click on View Details. And here we can see what was released in Microsoft's earnings. So what we're interested in is going to be slightly down here. So if you can remember from my formula, we have the total assets minus total liabilities divided by the basic weighted shares outstanding is what we're looking for. So let's start with the assets. Here we have the current assets, which are cash and cash equivalents and short-term investments. So that equates to $80,021 millions of dollars. We always have to make sure what the range is. So on top of that, we also have accounts receivable, inventories, and other current assets. So the sum of the total current assets is $147,180 millions of dollars. On top of that, we also have property and equipment, which is the net of accumulated depreciation of $74,945. We also have the operating lease right of use assets, equity and other investments, as well as goodwill, intangible assets, and other long-term assets. So the total assets, which is the sum of the current assets and the long-term assets, is $484,275. So remember, that is the first number we need for our calculation. Now let's move on to the liabilities that Microsoft has. So the current liabilities are the accounts payable, short-term debt, current position of long-term debt, accrued compensation, short-term income taxes, short-term unearned revenue, and other current liabilities. So the total current liabilities are $118,525 millions of dollars. Now, long-term wise, we have long-term debt, long-term income taxes, long-term unearned revenue, deferred income taxes, operating lease liabilities, and other long-term liabilities. The sum of both the current liabilities and long-term liabilities is $231,123 millions of dollars. So now we have the total assets, total liabilities, and we also need the number of shares outstanding. Now, the number of shares outstanding can be found right here. Under stockholders' equity, we can see that common stock and paid-in capital shares authorized 24,000, outstanding 7,433 in bold. That is the number we're looking for. Now we can walk through the calculation and see what Microsoft's book value is. Great, now going back to our formula, we know we needed 3 values. assets, liabilities, and number of shares. Now that we have these values for Microsoft, all we need to do is insert them into the formula in order to find the BVPS. So Microsoft's total assets are equivalent to $484,275 million. Microsoft's liabilities are equivalent to $231,123 million. And Microsoft's number of shares outstanding are 7,433 million shares. Now inserting this into our formula leads us to have the assets minus liabilities divided by the total number of shares outstanding. So $484,275 million subtracted by $231,123 million divided by 7,433 shares is equivalent to a book value per share of $34.06. And that's how you calculate the book value per share. However, there are some things to take into consideration. Let's take a look at these. So some of the limitations to consider include that the book value per share is based on a historical cost basis. This means that if the book value per share is calculated from Q1, then the change in price between Q1 and Q2 isn't accounted for, given the book value would be stable throughout that time, even if the company has made changes. Also, there's the concept of industry variability. Certain industries may have higher or lower book values per shares on average. Also, even in one industry, certain companies may have an average book value per share which is higher than other companies. Does this necessarily mean this company is a bad investment decision? Well, not quite, given that the demand for a company may increase its current market price much greater than the book value per share, but the demand makes the company worth that at the time of the trade. Next up is the concept of debt and liabilities. Now, companies may intentionally increase their debt when investing. So for example, if a company invests in research and operation between Q1 and Q2, that change would not be seen until Q2. And once it is seen, does it necessarily mean that the company has taken on too many liabilities? Well, not quite, given that this investment may actually grow its assets in the long term. However, the book value per share may not show that right away. Great, thank you for joining me here in Investinality, your go-to resource to weather all market conditions. If you're interested in more videos, make sure to subscribe, hit that like button, and add a comment below with other terminology you'd like me to go over. I'll take a look and consider it for next time. Happy investing, and until next time.